Hey everyone, welcome to my channel. I'm Doris. I'm here to share with you about my stock account updates and today's market. Today there will be no market operating because it's Saturday, so let's talk about what's been happening in the global asset pricing. How has it met its chaos during the worst October in 5 years? US stocks are on the verge of their worst October in 5 years, and down nearly 4% so far. The S&P 500 fell below the important support level of 4,200 to 4,117.37 by Friday, down more than 10% from the year high on July 31st, officially entering a pullback zone. During this period, the Treasury market experienced sharp fluctuation almost every other day. The yield on the 10-year Treasury note, the anchor of global asset pricing, soared by more than 5%, hitting the highest level since 2007. The COBE VIX index, known as the Panic Index, broke for 15 points to above 20 points. For those who are just used to buying stocks, on the dip with signs of weakness, the approach is also jaw-dropping. Among all categories of investors, they appear to be pulling out and strengthening their most defensive positions in a year. From a contrarian perspective, extreme pessimism often means a reversal is imminent. All pessimism is positive, suggesting that the potential of buying back could swarm into the U.S. market if the sentiment reverses. And where can this turning point be? Well, one possible turning point can be the Federal Reserve's monetary policy, or some positive market news such as the ease in the geopolitical conflict happening globally right now. And right now, the survey of active fund managers shows that the positions data are reducing their positions to avoid risk, with results of Microsoft, Google, Meta, and other tech giants in the S&P 500 index reducing their positions in those companies. The overall earnings season, the long-term Treasury yields also exacerbated selling pressure. From a theoretical perspective, the 10-year Treasury yield is equivalent to the R-index of the denominator and in the valuation model of the stock market. Wall Street analysts generally believe 10-year Treasury yields as a benchmark R value. In other indicators, especially cash flow, expectations did not change significantly. Even expected downward situation, the higher denominator level or continue at high. Where valuations of tech stocks, risky corporate bonds, high-risk emerging market currency valuations face the collapse of risky assets. A survey shows that the large players have reduced their shares to the worst of 2022, while hedge funds have pushed up the proportions of individual stocks for 10 straight weeks. Investor positions model shows that almost all investors, from mutual funds to systemic quantitative funds, have reduced their allocation to exposure to stocks well below the long-term averages. Whether the recent outflows are a precursor to a rebound or a long painful period will be a big question for the U.S. stock market heading into November. This is all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.